Where is your support level for the S&P? Because a lot of people do believe we're going to see more downside coming up.
Thanks, Frank. Yeah, it's been, as you mentioned, a brutal month in the markets. Unfortunately, I think in the short term that we're going to see further downside. So we're looking at 3,500, and then the market breaks through that. The next level we're looking at is 3,200.
So what you're describing is us basically giving up all the stimulus-related gains that we saw during the pandemic. What does that mean? Is that a situation where you would advise your clients to buy the dip, or is it a wait-and-see thing here?
Yeah, it's a great question. You know, if you look at where the 10-year Treasury is, we're at 3.7%. We saw 4% this week. I think it's very reasonable to assume we'll see 4% again. So if you look at the last time the 10-year Treasury was at 4%, that was in 2010. And as you mentioned, then at that point in time, the market was trading at a 16 times multiple. So if you look at the lowest consensus estimate on the S&P 500 for next year at $200 a share, you apply that 16 times multiple, and that's where we're at 3,200, which, 3,500 is 5% down from where we are today. 3,200 is 13% down from where we are today. So, what are we saying to clients? We're telling clients that it's important to be patient, be confident, look for value in different asset classes, different styles of investment, and hang in there, because I think it's going to get worse before it gets better, but we still are in a secular bull market. So, secular bull markets last 15 to 20 years. This one started in 2013. So I think it's important to take that long-term approach, but I think there's further downside from here.
Yeah, of course, we all want to take a long-term approach when it comes to our money, but in the near term, a lot of people are seeing a lot of pain. Are there any companies that you're looking at right now where investors can find opportunity today?
I think, if you look at energy, I still believe energy is the cheapest sector in the S&P 500, even though it's up 40% year to date. We're down 22% since June. So we like the big integrateds. Take a look at Chevron. Chevron has a dividend yield of almost 4%. They're growing their dividend at 6% a year. They've got a super strong balance sheet coming out of COVID. They've got great margins, especially in their refinery business, which I expect to continue given the structural imbalances we have in equities. I'm sorry, in energy. So I think that that's a good company to look at. But again, I think you have to be super selective and you have to be defensive in this market.
Yeah, of course, you definitely have to be selective. But I want to ask you, and I've been asking a lot of people this question, when you're looking at companies that can ride out this whole situation and this sell-off, what are you looking at? You just mentioned dividend investing just a minute ago and the dividend for one stock. Other people are looking at free cash flow or margins. What's your big focus when you're looking at the quote-unquote quality of a company that makes it investable right now?
Yeah, it's a great question. So what is quality? So to us that, we're very focused on strong cash flow, free cash flow, looking at the balance sheets of companies. But just much like we did in 2020, if you are in a period of prolonged economic slowdown, you look at the debt load of that company, you look at their free cash flow, can they sustain a period of prolonged economic slowdown? That's what we're looking at as it relates to quality.
All right, one last question before we let you go, Lizzie. Obviously, during the pandemic, a lot of individual retail investors jumped into the market. As we just said, they're probably facing losing a lot of the gains they made during the pandemic. What advice would you give to them?
There's nothing fun about a bear market. A bear market's much like riding a bull. The ride is not fun, but you need to be patient, you need to be smart, and you need to be confident. So I think, now is the time for those investors that did jump in 2020 to look, if there's opportunities to rebalance their portfolio into higher quality, take opportunities with tax loss harvesting. We're looking at a lot of Roth IRA conversions. So there's strategic changes that can be made as a result of the market, but I think that they need to take that long-term approach, know what they own, know why they own it.